I'd like to chat a little bit about commodities because one tends to forget that commodities are very cyclical. I say this because this week we had Thungela Resources, a coal miner, essentially just a coal miner, that has been a 10-bagger. In the last year, their price, a 10-bagger basically means you've got 1,000% return on your investment. And to top that off, you had a very nice first dividend, and now the first interim dividend for the next year has been released of 60 Rand a share. And considering that when the share came to market, it was far less than what the current dividend is. But why? Okay, it's basically because people have been switching off their coal plants. Production of coal because of ESG has stopped. And as a result, it's a demand supply thing, and that is normally what drives commodity prices, most commodity prices. The other group that produced results was Exxaro. I expected to have really good results. On a technical indicator, it was already showing that there was legs to the price with the stop of the stochastics. People were expecting it, even though it's on a very low PE. I think Exxaro's PE has often averaged under 5, in the region between 4 and 5. Thungela Resources is also on a PE, historic PE of about 2. But keep in mind that coal is carbon. I mean, there's plenty of coal still in the ground, plenty of coal fields. Obviously, people aren't spending money to mine because of a few reasons, and one is that banks have stopped investment into coal. Exxaro is an interesting one because it also has another commodity, and that is it's got a 50% partnership with Kumba in Sishen iron ore. Now, iron ore is also not that rare. There's plenty of iron ore around. In fact, we're surprised that the prices have remained elevated for so long, especially considering the property scenario in China. Now, China is really in a property bubble. They've been building like crazy. They've been using a lot of steel, and iron ore is one of those components that need to go into steel. So the chrome price is elevated, the iron ore price is elevated, but we're in a recession. Those are two minerals that you would expect not to be elevated in this type of environment, global environment. But a lot of it has to do with COVID and the cycles in which the commodities work. Now, in terms of coal's quite interesting because, as I said, it's mostly this ESG model that's driving it. But there's also a lot of contingent liabilities because these companies, when they close their coal fields, are going to be facing pretty hefty fines, including in South Africa. But we'll chat about that on another day. My point was just to bear in mind that commodities are cyclical. Some commodities you can almost preempt certain things, like copper is often a leading indicator of what's happening in the global environment. And copper's come down quite a bit, but more recently it's had a bit of an uptick. Maybe that's saying something. Timber is also pretty much a leading indicator of the economy. The timber prices come off after very elevated levels. And so these are all indicators that make me think we're very much in a recession. But we're also in an inflationary environment. So when you have high inflation and recession, we call that stagflation. Now, what makes this environment particularly interesting, let's go to the American situation. I think, looking at the way the stock market's reacted, is that there's certainly a camp that feels that the Fed is done with raising interest rates. Well, that can't be the case because they've got an inflationary target of around 2%. And even with the drop in inflation numbers in July, it doesn't matter if Joe Biden says inflation is 0%, that's not true. Over a year-on-year basis, it's still 8.5%. And inflation of above 8% is a problem when you've got a target of 2%. And that means that it's just a matter of how much the Fed needs to raise at the next meeting. So bond yields are showing that there's going to be an interest rate hike. And yeah, I want to talk about correlation again, and I want to come to the gold price because gold is very interesting. This channel is called Short Interest, and I've called it that because there are a lot of people that are short gold at the moment. They feel that there's somehow a correlation between yield and the gold price. And I won't argue that, but correlation isn't always causation. In fact, it very rarely is causation. So think about it this way. What happens when interest rates in a country go up? Let's look at Zimbabwe as an extreme case example. Or Venezuela. Normally those interest rates are going up when the currency at the same time is coming down tremendously. Now America have a special situation in that the greenback is basically the reserve currency of the world, and they'll probably continue to take advantage of that. So even with $40 trillion in debt, it doesn't really matter. The dollar isn't going down. But now I want to come to the point about what I'm saying about yield. Normally in countries like Venezuela, Zimbabwe, countries that experienced very high inflation, they experienced a devaluation of their currency. And so normally when you would see high inflation and a recession, you would see a devaluation of the currency. And when you see a devaluation of the dollar, there is causation in terms of people running to reserve currencies. Maybe that reserve currency is now these days cryptocurrency. There's not enough data to say whether Bitcoin's going to run up as the American dollar devalues, but one would expect that crypto would go up. But at the same time, don't forget gold. Gold is for centuries. I mean, there's 4,000 or 5,000 years of data, if you want to call it that, on gold being a reserve currency. So some people will invest in gold at certain times of the year as part of their celebration. That exchange presents, these gold coins and items of jewelry, normally 24 karat in these countries like India and the Asian countries, get stored away as a store of wealth for a rainy day. They get passed on from generation to generation, and it takes between 36 and 40,000 tons of ground and mass to just get 1 gram of gold. It's said that you could probably fill 2 Olympic-sized swimming pools with all the gold that's ever been taken out of the world, and the little section under the Eiffel Tower could be filled up with gold. Either one is analogies that I've heard. I don't know how true that is, but the point is, and Warren Buffett makes the point, in that every ounce of gold that's ever come out of the ground still remains in circulation. That's true, but gold is very different to carbon. It's not carbon's not a scarce commodity. Coal's not a scarce commodity. People wanted to go back to GoldFields because there was such a shortage they could do so. A part of the reason that the price has been elevated was Glencore on coal side signed a contract with Japan for an extended period of time at $375. They don't think that people are going to go back to GoldFields and mine coal. But if the world needs it and there's no other option, they're not going to have elevated prices because inflation is a real problem. So gold is a little bit different. Gold trades in a range. Over the long term, you'll always see that the gold price has gone up. Right now, we had just about a month ago gold going down to $1,690, and then it quickly shot up to over $1,800. For the last few days, it's been in a trading range of maybe 177 to 1740 to 1780, and so as a result, many people will trade gold short because of this belief that there's a correlation with yield, and there's this mistaken view that correlation equals causation. Keep in mind on this idea of gold being a safe haven that for many years in the early 1930s, leading up sort of to the Great Depression, 1933, gold backed the US dollar. Up and from Bretton Woods up until, that was in the 40s, up until 1971 when Nixon came out, the US dollar was backed by gold, and Nixon just suddenly made an announcement, so we're no longer backed by gold. This also coincided with inflationary environment where oil price started to skyrocket, and one often then relates back to that, and people talk about this correlation between oil and gold. But keep in mind that oil price drives inflation to a large degree. It's not the other way around. And the Fed's raising interest rates, all it's going to do is it's going to curb consumer spending. It really has got nothing to do with creating inflation. It's just a reaction to inflation. What creates inflation is a high oil price, because we use oil in everything and moving every single item. It's going to be around for a while. So, keeping that in mind, the point of coming back to gold. Gold doesn't care about yield. It really, really doesn't. It doesn't worry whether interest rates go up or not. What happens is gold is measured in US dollars. Gold is a safe haven asset. And as US dollars go up, gold will probably devalue as there's a strengthening in the dollar. Current environment, where the US has like nearly $40 trillion in debt, they are really, really struggling in terms of inflation and curbing inflation. It's not transitory as the Fed would like you to believe. The reality is that the US dollar should be worth far less than it currently is. In fact, I believe the United States needs a war to get out of this. They need to spend money on armaments, and they also need to be able to use the natural resources that they have to pay down some of that debt. So for the first time from 2021, the US had a surplus of natural gas. Now, the biggest supplier of natural gas in the world was Russia, and America needed to do something with the surplus, and they had so much they needed to get a good price for their natural gas. Now, I'm not starting any conspiracy theory. I'm just asking you to think about that in the context of what's happened globally in 2022. So should you be short gold? Well, if you look at gold itself, you get paid obviously to be short anything, but I think you would do so at your peril. If your thesis for shorting gold is the yield, you do so at your peril. Shorting gold miners, well, you would need to look at the individual mines. But if you look at some mines like GoldFields, for example, in the Rand contract, it's at 250 Rand. It's definitely been a support level, regardless of what the gold price will be. So I think, again, you will get paid to short gold, but you do so at your peril. Because when gold starts to rally, and it could easily move through the 1800 up to the 2000, even $2,100 mark. I'm not saying it will do so in the short term, but it could easily, and you don't want to get caught short any of those mining stocks. You're going to have to cover, and that's going to push up the price as well. So if you don't have any gold in your portfolio at the moment, in the current environment, don't be put off holding gold because of yield. I personally feel that it's a fantastic safe haven asset. People are starting to question whether crypto really is the place to be, because there are so many crypto coins around. So there's always a strong argument for Bitcoin, Ethereum, and so on, and for the concept of blockchain technology. But gold has been proven, it's been tested. And so there's a couple of gold miners that I like. If you're looking for a leveraged mine that you want to trade, Harmony is a great leveraged miner. If you can pick up Harmony at 51 Rand, obviously look at the exchange rate in terms of if it's under $9. I think it is. I'm not too sure about the ADR price at the moment, but look at the exchange rate at the moment. The Rand is fairly weak, and gold, a gold share like Harmony, can easily double from 51, well, can hit in the 90s to 100, all depending on the gold price. So that's something to keep in mind. Also, a lot of people don't like to invest in miners because of ESG, and I agree with that. As I said to you, there's between 36 and 40 tons of soil that needs to be removed just to get 1 gram of gold. And so in that context, you need to look at maybe like miners, like small miners that are cash rich at the moment. It's probably going to be sitting with about 1.3, 1.4 billion Rand in cash when they report now next month in September, and that is a little miner called Pan African Resources. They've put 30 megawatts of solar energy into the Evander and Barberton mines, and they intend doing that with all their mining operations. At the moment, they're producing about just over 200,000 ounces of gold a year. By 2023, that could easily rise to closer to the 210 mark, and 2024 it will be over 240,000 ounces the way they're going. But the point is, they're an extremely low cost producer, so they're producing at about 1,170 ounces. That's the all-in cost per ounce. And so if you've got a gold price that's sitting above $2,000, these guys are going to be printing money, just like your Tungela Resources is printing money now with a high coal price. The difference is that gold is a scarce commodity. There can only be so many mine shafts around there. Fair enough, a lot of gold that's been extracted at the moment is being extracted from tailings projects, and that means these big heaps that you see around Johannesburg, where gold had previously been extracted from the ground, is now being worked through, and they're finding those little residues of gold deposits that weren't found before in those that above ground body. But obviously it's much cheaper to get gold out that way than to sink a shaft down many kilometers. Then there is the other demand that gold has, and that is jewelry demand. Now, the demand for jewelry is also quite cyclical, but who doesn't like a nice gold ring, gold watch, gold chain? Especially is this noticeable in Asia. And then there's this rumor that the gold price is being manipulated for whatever reason. And it's not just a rumor, because there have been court cases where certain banks, certain institutions have been found to be manipulating them. So look, whether you want to hold gold or whether you want to trade coal or whatever commodity you want to trade, I think the point that I'm trying to make is it's very important to understand the reasons that you're doing so, to understand that commodities are pretty cyclical, and just be careful, because you need to understand what's going to move the price and what's going to move the commodity, and if you're investing in a miner, what's going to move it. So for the long term, if you want to just hold a gold miner that's going to grow, that's going to be pretty safe, very little downside, then Pan African Resources. If you want to trade gold, then Harmony is probably the first choice. There's a bit of corporate action happening at the moment with GoldFields that are buying out 50% of a Canadian miner. That's what's listed in Canada. It's actually a Japanese operation, and it'll end up making GoldFields the third biggest mining operation in the world. So around 250 Rand on GoldFields at the moment. So that's something that you could play. If you get in 252, 253 for the long term, I don't think you'll do badly on GoldFields. AngloGold is a very funny miner in that it's not as leveraged, but when the gold price does rally, this thing can also easily double in price. John Paulson, Jim Rogers, there's quite a lot of guys that are quite bullish on gold at the moment, and sometimes it's worth listening to the smart money. I'm certainly not the smart money. I'm just giving you an opinion, and I appreciate you taking the time to listen to this today.